There are standards available, so that freedom will be there for the banks to develop related models and the framework. But the ECL provision requirement may not exactly be the same for each of the banks. It all depends upon what retail portfolio they have, whether how much a proportion of corporate portfolio they have, etc., and what is their individual experience.
Has there been some analysis, and I'm sure you would have done, end of the day what everybody will ask, what will be the impact on bottom line? Because that is what was talked about. People have been speaking about 1 to 2%, to some even assessing around 5%. So what is the original assessment now, since the glide path is available and banks have already been preparing till now?
Yeah. While I think still the team is working on trying to consume, because these guidelines are anyway draft guidelines. So I think as compared to maybe sometime like 3 years back or 4 years back, initially when we started looking at what will be the impact on ECL, I think we have come a long way thanks to the lot of measures that have been taken by the banks in terms of strengthening their underwriting or instituting what is called some risk-related checks by way of credit review departments, etc. The underwriting quality in terms of the corporate has improved a lot. And you are seeing every quarter after quarter, the GNPA for the entire industry is coming down. So is the case with the State Bank of India. The credit costs are within the guidance. They are below 0.5%. That is the case with other banks as well. So we are in a good position to implement ECL. And as I said, while I can't put the number right now, given the kind of glide path of 5 years and given the current state of economic cycle, we are in the right position at the right time to implement the ECL norms.
And overall, how much it will have impact and as well as benefit for the banks as well? On the other side, do you think the underwriting will improve? Do you think the planning for the bank will improve after this?
See, one takeaway and one thing that will happen as part of adoption of ECL will be model frameworks, etc. are there. There has to be what is called a model governance has to be there. That means banks have to have internal teams or otherwise take the external assistance in terms of keeping an oversight on the model performance, tweak it as appropriate so that the outputs are more reliable. That will be one. Second thing is, from a risk management perspective, at the time of underwriting, at the time of disbursement itself, it is not like a small 0.4% standard asset provision what you will be making.
Right.
It depends on the asset class and it depends on your own ECL model what it says. So the team which is disbursing or underwriting will have an idea of what is the provision required. That means they will be better sensitive to the cost associated, and eventually it will lead to what we call a risk-based pricing. So I think if you ask me, like the overall risk management will improve because now it is the underwriter will also depend upon how they are going to manage the portfolio, what is the feedback loop from the collections to the underwriting, etc. So overall it is a good thing to happen for the banks.
And do you think more capital will be needed now? We can see, as including SBI, tapping the market for capital?
I think there will be some bit of additional capital requirement will be there. So to that extent, capital adequacy ratio may experience a small dent. But viewed it in the context of other guidelines which will also be effective from 1st of April 27, which is the credit risk standardized approach revision, I think it is going to provide some relief in terms of certain asset classes, particularly the MSME, retail, credit card portfolio, whoever are handling the credit cards as part of their retail portfolio, it is going to provide relief. So on a net basis, I feel like the impact will not be too significant actually.